what is the value of a dollar? Because all dollars are not created equal. A dollar is not a dollar is not a dollar.
Once we store it somewhere, invest it somewhere, spend it somewhere, they're not all equal. Things throughout time changes the value of what those dollars are worth based on what you need.
Something major is coming. It's already totally transforming how business is done, how services are provided. You're not allocating your capital for the past. Like, it doesn't even make sense. You're allocating your capital for the future. If X were to happen, would it derail your plan? If we can insert an X and the answer is yes, you have bad planning.
Hey, what's up, Hans? Back at it, man. Another episode.
Yeah, what's going on?
I'm hoping, I just bought the final supplies to get my new office set up, so I'm hoping that this is the last time I'm in this space as we record. We'll see if I can get it done in time.
Yeah, I'm looking forward to seeing the new digs.
Oh, it's going to look about the same. I ordered the exact same planks.
Nice.
Yeah, I couldn't find any other color I like, so I'm going to do the same plank background, and it'll probably look the same for the most part, but
So some lucky home buyer is going to get to walk into their basement and realize that this is the spot where Remnant Finance was recorded.
yeah, they are. It's going to someday sell for a lot of money, right?
I got a bum finger here. I don't know if you can see it, pretty swollen and not really too bruised anymore. But you don't realize how, I mean, obviously your fingers are super important, but like when you don't have use of one, and in my case too, because I'm trying to I got a splint that I'm keeping them together most of the time. You become really inefficient at doing just about everything. It's really frustrating. I was trying to do last week. My daughter has one of those little Fisher Price picnic tables out in the backyard, and we were running around, and I jumped over it. And then I was like, let me try a standing jump. So the bad news is that in doing a standing jump over the picnic table, I slammed this part of my finger into the side of the table, and it hurt really bad. Like, felt like a stinger at the time. And then eventually I think it's broken because it hurts really, really bad still a week later. But the good news is I cleared the picnic table with the standing jump. So was it worth it? No, but it did happen. But yeah, so next time if you're going to do something like that and your hands could potentially swing into it and cause a fracture or a broken finger, step over to the side. That's my PSA for the day. And don't actually jump over the table. Yeah, I'm only saying that because it like really hurting right now just from like doing nothing, which is frustrating. But I'm going to not focus on it.
Well, it's nice that when everything's running well, you don't even recognize the efficiency of how much your fingers work, much like the dollars that you have in your life. And are they created equal? Are your fingers created equal? Not until there's a pain point when you come to the place where you have to use that finger, right? And you recognize the value of it and whether it's as good as your other ones or not, and whether it's doing what you think it needs to do.
I see where you're going with this. This is a great tie into what we're going to talk about today. Like I said, at least I'm very glad it wasn't my right hand because I'm right-handed. And so at least it's my non-dominant hand. So I can do a lot of things almost as efficiently and then some things way less efficiently. But yeah, so today we're going to talk about what is the value of a dollar, because all dollars are not created equal. A dollar is not a dollar is not a dollar. So how is it true that a dollar is not a dollar depending on where it's warehoused?
Well, yeah, you took the first statement out of my mouth right there. Depending on where it's warehoused and where it's kept, because a dollar is a dollar is a dollar. If I hand you a dollar bill and you hold it in your pocket, or I hand you another dollar bill and you hold it in the other pocket, a dollar is a dollar. But we don't do that, and if we do, we're probably living in the woods somewhere, just wasting money. So, not many of us hold cold hard cash, and that's the only time that $1 is equal to another dollar is in cold hard cash. Once we put it in motion, once we store it somewhere, invest it somewhere, spend it somewhere, all the things you can do, which really, that's all you can do is spend, give, and save money are the three things. And part of your investing is part of your savings because it's inflows and outflows. So you have the money that flows into your life, you spend some of it, you may donate or give some of it, and what's left over is the amount that you're capable of saving. So from that savings, most people go straight to investing. So when they do those things, and the three things you can do, they're not all equal. And I mean, even if to just start at the broad level of that before we talk about where it goes and why, you can realize that even the spending of dollars aren't equal. Like right now, And where I live, we just had like a crazy storm last week. Like half of Pittsburgh is still without power from, I thought, what night was that? Maybe Tuesday night. There was like 80-mile-an-hour winds, knocked out transformers everywhere. Like most of Pittsburgh was without power. My house luckily was saved, but you know, a dollar spent on a generator a week prior is very different than a dollar spent on a generator right now because they're in scarcity. So people are spending
Hmm.
more. So even just right there, that's just an economic argument. But what's your dollar worth to you, and how you spend it on things throughout time changes the value of what those dollars are worth based on what you need. What you give to, you even think about it, it's like an aggravating thing to me every time I go to a store and it asks me, "Do you want to donate to our charity?" Like, no, I don't want
Hmm.
to give money to the charity that you supposedly vetted that I probably don't believe in. Like, I'm going to give money to something where I think it's a worthwhile cause. So the value of that dollar based on who it's given to and how they use it is actually different because that's an emotional attachment. So the emotional attachment of your dollar values it differently. And then we go into, those are the two ways that money flows out after it flows in, before it's saved or invested. And so we're really targeting that savings and investing side, but the saving, what environment is it on what timeline is really what we want to talk about.
People are already doing this. You already have an allocation plan. It might not be a plan you thought of or that you think through or that you were even aware that you're doing, but your dollars are doing initially out of the gate. They're doing one of those three things: save, spend, give. And when we like, if it's going out the door in some capacity, it's going somewhere. So this is already happening. We just need to think more through it. And so we always get back to, people blur the lines between saving and investing. People say they're saving for retirement when they're actually investing for retirement. They're putting the capital at risk. People say whole life is not a good investment, and yeah, you're right, it's not an investment at all. And so these distinctions on the surface are very easy, and people and what we want to do is we want to run through different attributes that you should ascribe a dollar, like give every dollar a report card. And that report card is going to be multifaceted. It's going to be, there's a list of traits you should be thinking about. There's also different phases of the life cycle of that dollar in your personal economy. And so depending on what phase it's in, depending on what phase of life you're in, is going to change as far. So like if you have a report card on the left and you have all these attributes, and on the right or on the top axis you have the different phases of where it could be, each different account, each place money could go is going to have checks in some boxes and not in others. Some dollars are going to be great during your growing years and not good during your distribution or your estate years, after you're gone. Some are going to be great to earn dollars this way, and some are not going to be great to earn dollars this way. There's efficiencies across all these different facets. And so people are all familiar with one, which is just how high is the dollar value. That's always, always, always the main challenge. Why would I put money into a whole life policy when I can put it here and get more money? I could make more money elsewhere, right? That is literally the primary, and I would say only, challenge that people have, is I could make more money elsewhere. There's no discussion of any of these facets, any other things on the report card. It's just higher dollar number is always better, and therefore that's what I'm going to do. And so we need to put a lot more nuance on it, and you should have a well thought through strategy, and you should understand every dollar that's currently existing somewhere in your personal economy. You should understand how it stacks up in different phases across these different metrics.
Yeah, and over time. Typically, you're saying the blanket advice that's given is just that, like, if you put your dollar here, it's going to give a bigger number now, and bigger is better. Bigger is always better, right? That's
Mhm.
like what we typically hear. Like, well, you can get more in this high yield savings account. You can get more in this growth stock mutual fund. You can get more tends to be all we ever hear about. And more isn't always better. Is that essentially what you're saying? Because it depends on some of these variables. Is more better in a certain place based on like, how do we know what the taxes? We always talk about that. Like, would you rather be taxed on the seed or the harvest?
Mhm.
Even with all this tariff and this crazy stuff going on in the economy, the one thing that's driving me nuts is that if we're supposedly bringing all these billions of dollars in via tariffs in the future, like tax, nobody's talking about tax reductions. There's no action
Mhm.
there, right? So now we just have this double taxation. So we always say What do you think, based on the national debt and the trajectory of what's happening with the spending in the government, our taxes are going to do in the future? Do you think they're going to go up and down, up or down?
Well, yeah, we think definitely up because the spending is there's no attempt happening to cut the spending. We thought there was going to be. It seemed like there was a pretty out the gate, a pretty hard charge to reduce spending, and then we just find out, oh, well, actually now we have $1 trillion military budget. We took all this money that we said, and we all celebrated. We said, hey, look, they're trimming all this fat, getting rid of U.S. aid and all these, the Doge efforts. Look how much money they're going to save. Well, we'll see. It appears as if all that money is just going redirecting elsewhere. There don't appear to be any intent on actual cutting the deficit. And so if we're doing this, I expect taxes to keep going up. I don't see so far any reason to think that they're going to go down.
So, just to think through like the very most basic part of this, if I can put money, whether it's before tax or after tax dollars, depending on who you talk to and what they think is better, into a place that's going to grow, 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 and then, if you're 35 years old and you're going to retire or whatever you're going to decide to do in 30 years, and those taxes have gone up by multiples of what they are now, was grow, grow, grow great?
No.
When you start to take the distribution,
Yeah.
it's not efficient anymore, because now every time it comes out, you're going to pay a higher number of taxes on that money. You really haven't gotten ahead. So it's just an easy discussion around, like, is more always better?
Yeah. This is about bad planning. Like we're not going to draw up report cards and walk through. I mean, I listed on our sheet here, I go like 15 different attributes that we need to consider when we have a dollar. And on none of them is magnitude of the account balance, because that is, yeah, it matters, but like it's a given and it's not the primary thing I think that matters, especially as you go across these phases. But at the end of the day, this is about bad planning. Let's go back to last week. We reviewed that Dave Ramsey video where a guy called in and said, I have whole life policies. And the answer was surrender them and put them in a mutual fund because you'll make more money. And it's like, never once, and it blows my mind. Like, we will say this is not financial advice. You'll hear many people on YouTube say this is not financial advice, not financial advice, not financial advice, not financial advice. I don't know how he gets away with it, but he doesn't say this isn't financial advice. He literally told a guy on air to cancel your policies. And the million plus people that watch that video who might have whole life without any consideration of their individual circumstances, without a single question asked, not only to the caller, but to anyone else listening. I mean, how many people might have surrendered whole life policies listening to that? That was financial advice.
Yeah, it was.
It's so destructive because, I mean, we've had clients that we talk to and we say, hey, right now, whole life's not a good fit for you, right? Because we're looking at a myriad of circumstances about your spending, about your personal economy, your need for insurance, right? That those things are individual to every single person. So we don't have the same policy for any two people unless it's incidental, because they might happen to be very similar situations. Military officers have a lot of similar pay features, right? And so, there are situations where people have similar policies, but it's not because we just say, yeah, okay, you're 34, you need a policy this big. No, it totally depends on the person. And so if you're not having a conversation, if you're listening to some advice, some actual financial advice, which this is not, I guess we have to say that. Dave doesn't have to say that, but I guess we do. This isn't financial advice. But if someone is giving you financial advice, whether they say it is or isn't, and they don't ask you a single question about what you need these dollars for and what attributes you might like in your dollar, and they're only going off of the low-hanging fruit of this would have a higher balance, you should run away from that and you should reject that entirely, because that's terrible. Like that's like immoral to do that, because it frustrates me that someone likely had a fantastic whole life policy, probably had been paying into it for a long time, and then surrendered it at its most efficient. Every day that goes by, your policy gets more efficient. So if you're down the road and you understand how policy mechanics work, like that could have been a gem of a policy. To surrender it without getting a single question asked about you is unthinkable to me. And it's infuriating. And just the lack of depth in the conversation that is inherent to that type of mentality, the Dave Ramsey planning mentality, where everyone just blanket advice, do these things, is infuriating.
It's infuriating for multiple reasons. Like, do you think a recession is coming?
I think it should be coming.
The actual answer is always yes, because the business cycle we live in, and the cycle of what happens. Like, the answer is always yes. That's why it's actually funny when you see all these planning, or all these different folks out there that say like there's a certain percentage that a recession is going to happen. Like I always expect a recession to happen. It's going to, because we live in the business cycle of the printing press, more or less, without going into depth on why. But a recession's coming at some point. Were you alive in 2020?
Yeah.
Yeah. Do you remember what the average cash reserves a restaurant had? I remember reading this statistic. It was like 14 to 17 days.
I'm not surprised.
Yeah, it was like 14 to 7 days. What's the average burn rate? Like, has a single person out there, like when Dave Ramsey does that, like, does he ever ask them, like, he talks about his budget, but it's just like, well, what do you spend every day? If you were to average all of your expenses through the year, what's your daily burn rate? If we just, figure out what goes out in a whole entire 12-month period, divide by 365, that's your daily burn rate. How many days of liquidity do you have? Everybody talks about 3 to 6 months, but there were people that were out of work for a year in very recent memory that it seems like every financial planner has forgotten. So when we're talking about the value of a dollar, if I have a dollar in an environment that gives me guarantees, that gives me access, that's efficient, I think access is huge there. Being that it's liquid, I can access it now. And I have just saved in a place with a nice compounding effect, true compounding effect, not just the value of the equity, but it's actually compounding in a place where when I access it, I don't interrupt that. And 2020 happens again and something happens and I can't work for a year. To have had a nice savings environment, the value of that dollar that I can access without interrupting the compounding, to me, is probably triple and quadruple. I really shouldn't put a numerical value on it because I don't think it's numerical, but the dollar that's in the growth stock mutual fund that I just interrupted, if I have to get it and maybe have to pay a penalty and maybe have to pay taxes on it now in the moment that I need it the most. Like, nobody ever talks about just actual true liquidity at all times. Like, how much should you have? How much is enough? I can tell you, like the prepper world, and they save, food for years on end. They always say like, well, how much is enough? And it's like, the minute you tap into it, it's not enough. It's kind of like their mantra, right? The minute you start needing to access your food storage, you don't have enough of it. I think that's extreme. However, like, nobody ever attacks, like, are you liquid in a guaranteed and accessible environment? And what's your daily burn rate? And how long are you comfortable knowing like nothing in your life needs to change? Is 3 months really comfortable? If you're a restaurant owner and they shut your business down, are you really comfortable assuming the government's going to bail you out again, knowing you have 2 weeks of liquidity? 2 weeks. And then you can't pay a single person. You have no income. The efficiency of the dollars in a place that's guaranteed, accessible, and liquid has way more value in that moment, in that phase of time. That's even present day. We can get into the future of what the estate looks like, but in the present day, that's more valuable than everything you have in the stock market because it's probably plummeted too.
I mean, this isn't an episode necessarily about the flaws of the conventional model because we hammer that pretty heavily, but we are talking about how you need to be thinking through this because the conventional model is going to ignore all of this. And so think about like you flip a coin 10 times, right? And it ends up being heads 10 times in a row. You would say, well, it's got to be tails next, right? This is like very basic stats. The previous iterations have no bearing on the future. If you're doing 10 coin flips, I'll keep it easy. So you had 9 in a row and they were all heads. Well, if you had started at the beginning of that iteration and said, well, what are the chances that at least one of these coin flips is going to be tails? It would be close to like 100%, right? Because it would have been 50 on the first one.
Higher.
So sorry. Yeah. So like it'd be almost a certainty that with 10 flips to go, one of them is going to be tails. Very, very high certainty. But if you have 9 heads in a row and now you have only one more flip, that certainty doesn't matter at all. Now you're still at a 50-50. It could be just as easily 10 heads in a row at that point, even though starting out before the first flip, the possibility of getting 10 heads in a row is extremely, extremely unlikely.
Yeah, it sounds to me like you're a casino. Well, you got a weighted coin if that's happening.
Yeah. So the past doesn't matter that much when we're talking about when we're planning for the future. Everything you're doing with your money, you're not allocating your capital for the past. Like, it doesn't even make sense. You're allocating your capital for the future. And the past matters a little bit in so much as we can discern trends, but those trends have no bearing on right now. That the market did X over the last X years, that this fund returned Y over the last, however many years. Like, that is interesting to note. But if your plan can be shattered, if we could just name one thing that could just totally derail this plan, then it's not a solid plan. Like, what if, during '08, there was like, what is it, a 2-year window? Scott talked about it a few weeks ago. Well, it was all like a 2-year window of the market not gaining anything or going down, right? And so we assume that can't happen because 8 out of 10 years the market's up. Over the last 70 years the market's up, right? We just assume these things can't happen because they haven't happened, and when they do happen, they happen small enough that market's always going to go up. But what if we have what Japan has, and let's just say we have 10 years of stagnant growth, and you just retired and you've been following this plan? Like, does your plan require trends from the past to continue in the future? And then that aspect of relying so heavily on past performance, when that's not guaranteed in the future, that should be obvious, but that is not a sound foundation for your strategy.
It's really not. And I mean, just if you think about industry too, I mean, I'm kind of going on a tangent here, but if you think about industry, like if it were 1875, I'm a blacksmith and I make shovels, or, I make shovels and hand farm equipment. All of the past data would show that my industry is going to be strong and up forever because 70% or more of people were farmers doing manual labor in America. And then all of a sudden, like, engines come along and tractors and combines and things like that, right? That they don't have the need for all this kind of stuff anymore. So in that particular industry, like, it changed forever. And right now we are on the very, very, very early phases of the biggest disruptor of our lifetimes. Well, maybe second disruptor, because the internet was obviously a big one, but AI, it's going to change everything. Absolutely everything. And I mean, look at a Tesla plant. There's like no people. It's machines doing work, right? And AI is growing. Now it's self-learning. So how can anybody predict the future based on industries that probably won't exist? Because all that data is based on something. I mean, we haven't even hardly touched what AI is about to do, in my opinion. It's going to completely change the world, and I have no idea. It's probably going to be like way better in many ways because everything always has been. When cars came, when airplanes came, when trains were laid, like, everything got better, but it disrupted the entire industry that was behind it. But nobody can predict what, like, these stocks are going to do that have this legacy in manufacturing, this legacy of what they've done. It's all about to change in our lifetimes, probably inside 10 years right now, because it's happening so fast. It's happening at lightning speed like no human beings have ever seen. So assuming that you can do things with your dollars that worked in the past may be a pretty bad assumption. But the one thing that I believe you can do is save the dollars that come so you have liquidity, because as these changes come, I want to have access to that money, because I don't know nobody knows where's the place to put it right now. When it comes to the investing in these new technologies that are coming out, nobody really knows yet. Everybody's guessing. People are getting ahead of the curve, but it's happening so fast. So yeah, all I'm trying to say is to agree with you that all that past that has happened is meaningless. We're in the middle of the biggest disruptor we've ever seen.
My takeaway from that would be is the speculative part. Like, you're right, something major is coming. It's already totally transforming how business is done, how services are provided, but we don't know what's going to look like. And everyone can get on board with that. Like, no one's going to say with confidence what AI is going to do. There's tons of people talking about it and everyone's speculating. We don't know what AI is going to do, right? The same way, like you said, the internet. And so we all can agree with that. No one knows exactly how this is going to look, but it is going to be a major disruptor, and things are never going to be the same as they were, say, in the 90s or even the 2000s. We all know that. But then we revert, when we're talking about planning for our financial future, we revert back to, well, over the last 80 years, the stock market has done X. It's like that. Okay, well, maybe it will, maybe it won't, but just relying on historical data as if it has any bearing on the future besides a trend, and so when I see something like that and people have the entirety of their savings, the entirety of their retirement plan in the market because over 7 years it's gone up. I mean, the microeconomic changes that are happening right now, the attempt to keep world reserve currency, some of the stuff that I talked about in my couple solo episodes there's big changes on the horizon there too. Maybe if those changes happen, if we lose reserve currency status, or if we do the one thing that needs to happen, if we're going to try to maintain solvency, which is like getting control of the interest on the debt, what if we have some deflation? And what if the deflation would cause there'd be like a downward spiral, right? If we have a debt deflationary spiral, which could happen in a debt economy, what if the markets actually get down to the value where they should be based on the value provided? What if asset price inflation stops? What if the Fed stops creating money? Congress stops spending money? Like we said at the beginning, we think taxes are going to go up because we think they're going to keep spending money. But is it in the realm of possibility that they stop? Yeah. Is it in the realm of possibility that the clash right now between the president and Fed chairman, like what if the Fed is just like, okay, hey, we'll crank interest rates up even higher? I think they should do that because I think we need this fever break. But let's just say they do that. And now all of the asset price inflation of decades and decades that we're relying on for future planning just comes crumbling down. What if it's stagnant for 5 years? What if a 5 year sideways market and 5 years from now, you're starting at exactly where you are? Well, how do those projections when you're at retirement age in 30 years look if you trim off the last 5 years of the hockey stick? Way less, right? Are you prepared for that? If X were to happen, would it derail your plan? If we can insert an X and the answer is yes, you have bad planning. If you are doing put it in a mutual fund because it grows larger, if that is your plan, just it growing larger because of external factors, if that's your plan, that's a shit plan. And so I want to give a case study of, going back to the value of a dollar in different accounts, a very timely proof of concept for IBC that kind of walks through how the value of a dollar is different across different elements of an asset. A client of ours purchasing a property, very wealthy client, so these numbers are very high, but don't get hung up on the numbers. Purchasing a $7 million property, brought $3 million to the table, so needed a mortgage for $4 million. Right? Goes to the bank, rates at the time are like 6%, says, hey, I'm going to bring 3 to the table. I need to borrow 4. That's, and the way we think about mortgages, that's pretty easy, right? If you put down more than, coming up on 50%, like,
yeah, almost 50%.
Yeah. If you're putting down like 50%, like, okay, yeah, no problem. Well, they said no. He said, okay, well, let me collateralize with one of my other properties that's worth about $4 million. So now you get $3 million down and collateral of a $4 million property. Let me borrow $4 million. They said no. I'm accelerating the timeline. This is over the course of several months. By the end of it, said, okay, 3 different properties valued at $17 million are posted as collateral. I'm bringing $3 million to the table. So your total stake in this is $20 million to loan me for. And the bank said no. What finally got them approved for a 9% loan when the market rate was 6 was having $600,000 in cash deposited into the bank with a guarantee to sit on it for 6 months. That element finally got the deal done. Okay. So what is more valuable, more or less valuable isn't the right metric here, but think of the value that $17 million in collateral had plus $3 million down could not move the needle enough, but $600,000 on deposit in the account did. Now, this is my biggest client. Our biggest client called me and said, hey, I need to put $600,000 down. I know I pay big premium. I know I have a lot of cash value, but this isn't moving the needle on a $7 million deal. But he had multiple 6 figures of cash value. And so he said, what do I need to do to get that money? I'll use a part of that towards this $600,000 I have to put in the bank. And just because they wanted so badly money to sit on. Now, that should be like bells in your head should be going off. They desperately wanted more than $20 million. They wanted 600,000 to sit on and hold and bank with right now in cash. So I said, hey, all you got to do is tell me how much you want and what account it goes to. So we did a policy loan. 4 or 5 days later, when the bank is putting them through the ringer for a loan that's just over 50% of the price of the house, within 4 or 5 days, guaranteed, he had his cash value ready to go. Put that in the bank. That got him about a third of the way towards that $600,000 requirement. And what he said was, hey, this is awesome. It's not really helping too much with this requirement of $600,000. It's getting me a third of the way there. But what it really tells me is, had I been doing this for 10 years, I'd have a lot more I wouldn't have had the stress the last 3 months. So that a couple of the facets that we talk about on the report card, guarantees, access, liquidity, those are the first three that we listed because those are lacking in a lot of the accounts that people would compare when they say, I'm not going to do this because I want to do this and grow more. Well, okay, but you can't access it. If you want it, you're not going to get it. The value of $600,000 deposited in the bank is what they truly wanted to get a 9% loan. I mean, and I'll wrap up this point here. When we talk about, we have these ideas of things that are true. You bring 20% down, you don't have PMI on your mortgage. The market goes up 8 out of every 10 years. Set it and forget it. Buy low, sell high. Like the market's always going to go up. Real estate's always going to go up, right? We have these truisms that have held true for a long time. So there's a reason we're conditioned to believe them. But in this case, 3 million down, 17 collateralized, and $600,000 in the bank got him a 9% loan to borrow for. Okay. That is shattering. And that's because liquidity is drying up. That's because banks are tightening the purse strings. So when that's happening and investors like my friend, what if someone else had the money in cash and cash value that they could guarantee get to? Because it's not like my friend couldn't pay this loan, right? They're worth many, 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 many millions of dollars. It's not like you had a hard time for them to get, come up with 4 million over time, but they did it this way to borrow from the bank and the bank put them through the ringer. So next time everyone else is being put through the ringer because of forces beyond their control, i.e. the market, everything that's happening that you don't control. What if you had access to cash value that they couldn't say no, and the guarantee is going to be in your account in a couple of days? How valuable is that? Are those dollars different than your mutual fund dollars?
Yeah, right now, especially, I think when the economy seems to be rocky, who knows what's going to happen? Like we mentioned, the tariff stuff, and that seems like it can change every single day, et cetera, et cetera. It's like having access to a pile of cash to spring on opportunities or to handle emergencies is going to change the game for anybody that has it. Access to liquid available capital is going to be the most powerful thing you could possibly have, I believe, in the coming years.
So that hits a couple of them: guarantees, access, liquidity. Those are huge. And the highest report card grades are going to be on your cash value. Guarantee you that.
Mm-hmm.
Every other asset, every other place your money could be sitting is going to have some measure, but they're not going to beat your cash value on those. Now, each place of money sitting, it should have a purpose depending on the phase of your life, depending on the phase of your financial economy. Like some dollars don't need to have guarantees at the time. Like your investment where you want to grow, that doesn't need to have guarantees. The whole reason you're expecting an outsized return is because there isn't a guarantee. You could lose it. But that's what you're intending to do with it. If you're strategic with it and you understand where it is in the life cycle and what you're doing with it, that's fine. So not every dollar should excel on all of these fronts, but we will make the case, if we were to go through each of these factors in detail, cash value stands up highly on just about all of them and competes with them on just about every factor. So what are a few other factors we want to consider when we're talking about the value of a dollar?
The fact that it's private, the volatility that you don't have because these have been planned out. The insurance companies, it was funny, I just sat in a room with the executive for one insurance company, and they are constantly thinking about how can we get through the absolute worst economic phase with the way we move our money. So they are prepared. The company we were sitting with actually was profitable in 2008 and 2009 as their overall portfolio was profitable in the worst economy and the worst downturn we've ever had. So you're in a place where there's no volatility. It's not tied to the market, or if it is tied to the market, it's on a very small scale. Your money in particular, because of the guarantees associated with that contract, is absolutely not correlated with the market. You are going to get the guarantees. You are probably going to continue to get dividends. You're protected from creditors. If all else goes wrong, that's a pretty powerful thing. So just looking at all of the major things that are tied to the contract and whole life insurance really makes the value of your dollar there stronger than anywhere else I know of. And it's going to leave a very healthy death benefit should you die.
Some of those protective features are invaluable as far as, this is a minor one in my opinion. When you're filling out the FAFSA for your children, if they're going to college, your cash value is not an asset on there.
Yeah, that's true.
I'm not worried about that. College planning is not really in my future. If it happens, it happens, and it'll happen efficiently if it does, if my daughters make the decision to go. But I don't, college planning, I'm removing that from my financial outlook and picture. That's invisible from a lot of entities.
Something else that we talk about with anybody that's going through the process with us too, and some choose to take it, some choose not to, some are not eligible and don't qualify, is a waiver of premium in these policies. So we've talked about it in prior episodes, but it's like an insurance on the insurance. So if something happens and you become too sick or hurt to work for whatever period of time, all the way up to age 65, this waiver of premium rider will pay your premium, and your savings plan, because we treat this as savings, completes. And as we've talked about over and over, somewhere around year 4 in an insurance policy, every dollar in is attributed to cash value. Your cash value will rise by every dollar you pay in premium or more, typically around year 4, not always, depends on your ratings, if you're on a table, stuff like that. But, imagine something happening in your life and you become disabled and you can't work for the next 20 years. Like, your employer's not going to continue contributing your 401k. You're not going to have the money to keep putting into a growth stock mutual fund. But this goes then at that point, if you became disabled, this goes on autopilot, and you still have a savings plan where you still have access to those dollars. You still have all the contractual rights of the policy, liquidity, growth, emergency fund, whatever, everything that we talk about, the power in this policy exists. So when you talk about the value of a dollar, like, that's invaluable in the event you need it.
Yeah.
Imagine having a place where your savings plan completes if you can't complete it yourself.
Yeah, that's huge. This is the only product where that's an option.
Yeah.
If you qualify for it, it's invaluable.
I think it's so smart to take it. I take it on everyone I can. I haven't always been able to get it as a military pilot, but the policies where I have been able to, I 100% of the time want that on there.
Yeah. I mean, right now I can't use one finger, but what if that became 2 legs? Who knows? Who knows what's going to happen? The future's unknown, right? And so if that were the case, where this is the strongest asset in my family's economy, and when I explain all of these values of doing infinite banking, of understanding what this system, what this policy does, if you think of the dam, you're plugging up so many holes when you implement an IBC system. Just running through this list that we've sort of bouncing around, but guarantees access, liquidity, growth, protection, transfer, visibility, volatility, protection from creditors and liability, probate, federal gift and estate tax implications, dividends, loan, collateral uses, all these things that we talk about. Well, there is one hole that remains. If you plug up all those other holes, there's still one hole in IBC, is that you still need to continue to pay the premiums. And so what if you found yourself in an unknowable future situation where you weren't able to work at your current job? Would you like the company to continue to make those payments for you to keep the policy in force? If you have that option, you don't have it anywhere else. The mortgage company is not going to do that for you. Vanguard's not going to do that for you. Whereas one product in your suite of financial tools that can be self-completing in the event of a disability, that is invaluable.
Insurance. And the one thing that you missed talking about all those attributes of a whole life insurance contract, and the one that's so powerful and the reason we love it for the purposes of taking over the banking function, is constant compounding.
Mm-hmm.
Whether that's, you mentioned the loan and collateral uses, but when we take a policy loan, the value of our contract continues to grow. It continues to compound in a constant rate, or not necessarily constant rate, because it depends on the dividend changes, but it continues to compound constantly, regardless of whether or not it's in use. And that is so powerful. Nothing else. You can collateralize stocks, you can collateralize other things in the same way, but you're always at the mercy and the control of somebody else and their willingness to do that. Mm-hmm. So you're still not really acting as your own banker, because if all those stocks plunge, things change. Terms change. Access changes. You never know if you're always going to be able to do that. Yeah. So that's, all the things you listed, plus constant compounding through all cycles of the economy. Pretty powerful.
Yeah. Now let's fast forward to a future inevitability. Let's run through how a notional conversation might go. So again, we're always addressing husbands by default, because that's the majority of our clients. So let's just continue with that. Let's say that you don't wake up tomorrow. If you work with us and we're the ones who would be having that conversation with your wife about, hey, how do you want these death benefits paid out? Or if you have a trust, you're a trustee. If you have no will, no trust in place, then a government lawyer. If you can't identify immediately the person who would be having that conversation with your wife about what's going to happen if you don't wake up tomorrow, as far as all of these assets, you should pause this and fix that immediately. Talk to us, get someone in place that can fix that immediately, because the panic that's going to happen if you don't wake up tomorrow, if you're gone from your family tomorrow, like, you do not want to be leaving these things to your wife to deal with without any kind of guidance or understanding of what are all the implications. So on that report card we talked about the different phases. One of those is estate. One of those is after you're gone, how are they distributed, right? And so when you're in that phase, each of those dollars in different accounts, in different assets, scores differently, again, on all of these things. And so if you could fast forward and say you do have that person in place and you do know who's going to be having that conversation with your wife about how are we going to distribute this, let's make sure we understand the implications of selling this versus this. Do we understand the cost basis, tax implications, all of these things, right? You have that trusted person in place, or you have a trust, and the trust is going to go according to your will. Let's assume that piece is in place. Now we ask your wife, okay, you have X number of total dollars. How many of those dollars would you like to be in different buckets? I would say, if they understand, I want as many dollars. If it's the opposite and my wife passes, I want as many dollars that I'm going to inherit, or for my children, whatever, I want those dollars to be in the form of death benefit, because it's shielded from all of these, everything we just talked about. It still stands up on a lot of these because it grew. Certainly it got the guaranteed growth because it goes from whatever the cash value is today to tomorrow. If I pass, it goes to the full death benefit amount. It's going to multiply several times over, pass to my wife, tax free, free of probate. If you don't know what probate is, that's the process by when you die. If you just have a will, you're going to go to court, and the probate court is going to distribute those assets according to your will, unless someone says, I have a claim on them. Anyone with a blood connection to you can basically sue in probate court, and your heirs would have to defend like it's a mess. It's a feeding ground for probate lawyers, estate planners. Like, you do not want your assets going through probate. And so in this case, I would want every dollar that leaves me and goes to my wife when I'm gone, or to my children. I want every dollar possible of that to be in the form of a death benefit from an insurance company, because of all of these guarantees. And if you've never thought through that, like that stupid conversation we reviewed last week, where it's like, you have $2 or $3 million, I'm sure your wife will be just fine. I mean, that's a effing terrible way to have that conversation, which led to someone canceling many, many more dollars that
would have flowed into her life. Yeah.
Guaranteed tax free. $2 or $3 million. Well, is it 2 or is it 3? That's a big difference. That's a 30, that's a 50% difference between going from 2 to 3. That's huge. Okay, $2 or $3 million. Well, are these dollars in the equity of your home? Do you have a $2.5 million home and $500,000 in a brokerage account? Well, now you got to sell the home. Like, that's not going to get you anywhere. Is it $3 million of death benefit? Well, that's awesome. That's tax free, going directly to you, not skipping probate, right? But like, you have $3 million, so your wife will be fine. Well, did you ask what those dollars are in? Like, it's so bad. It's like a bad thing to do to people. You are leading people off a cliff. It is bad.
Yeah. I think we hit that pretty hard last time. But so all I want to say is that if you don't have a plan in place right now for your death, if you don't have an estate plan in place, get in touch with us. We'll point you to somebody that can help you get a revocable trust done, a living trust in any state in the country. And if you don't have a plan, everybody has a plan. But if you haven't created it, the government has one for you. And you probably don't want to go through the government's plan, which is what he was talking about with probate. It's awful. Done it with my family. It's just a pain in the butt. Ours was clean, and it was still a huge pain in the butt. It still took almost a full year until we were able to actually access the funds for all the sales. It has to sit until they decide it closes. You don't want to do that. So create a plan. If you haven't, call us. We'll just hand you off to one of our partners who are experts in that regard. But you don't want the government's plan. Trust us. But yeah, anyway, let's wrap this up. Any final thoughts?
Gotta cool down, because that video is so ridiculous. Think about this idea of a report card for each dollar. Think through these attributes of it. We covered some of them. We listed more, but like, you should be thinking through each of these, anywhere your money's going to go, whether it's your Roth IRA, whether it's your mutual fund, whether it's your cash value, whether it's your home equity. You should be grading them on the report card. And you should also, you don't actually have to sit down and draw out like check boxes and stuff, but think about it through. How do you want income coming into your life? When you're saving it, what are the attributes you want and which assets fulfill that? When you're growing it and investing, which attributes do you want to highlight? Which vehicles will get you there? When you're distributing it in your later years, which assets are going to get you there? And then during the estate phase, that's the easiest one of all. There's really no, there's first place and everything else. There's really no comparison. But you think about these different phases, because that conversation clearly is not happening for the largest financial audience in probably in the country, as far as like financial content goes. For the largest segment of financial listeners in the country, they're not getting a single tailored piece of advice. And that's bad. Like we should be thinking through these dollars, because a dollar is not a dollar is not a dollar. I'll end with that, because I could just get hot again.
Yeah, and I want to actually add, think about how you're spending money, because you got to think about your time. In the earning phase, and the saving phase, and the spending phase, before we think about growing, distributing, and your estate, is what's the value of your time? It's probably the most value thing here that we often attribute dollars to, because so many of us trade time for dollars. Are we spending in a way that is efficient for our time? And I'm going to use the example as if you're self-employed and you can earn $100 in an hour and pay somebody to cut your grass for 30, 40, I don't know what it costs to get your grass cut these days. Is it a valuable use of your time to do that labor when you can earn more? So there's a value of the dollar when it comes to the earning, the spending, and the saving as well. You have to correlate that with the time in your life and what's more valuable to you. And when it comes to your time, spending it with your family, spending it doing things you don't need to be doing, or saving it, or just working more and more and more, because everything also isn't about money. There's values of our life and our family time and other things that come into play here too. So you can't always just quantify the value of your dollar. You have to include time. We live right now on this earthly plane in a linear world. Time is linear. So once it's behind you, it's gone. I think that just the idea of what's useful in your life also plays into how these dollars should be allocated.
Good way to bring it back to more of a metaphysical approach, but it's very true. Yeah.
All right, man.
All right.